All right, homeowners or prospective buyers that are thinking, should I buy now or should I wait? Is the market about to crash? Are we about to see it fall out or are we about to see it shoot to the moon? What kind of data should you be looking at to figure out where the market is going in real estate? We're going to look at this, and more importantly, we're going to look at what data should you not be looking at that might lead you astray. The good news is, unlike the last really large real estate crash that we had in 2008, the internet has a lot more data that you can be looking at. Keep in mind that in 2008, the internet was actually still kind of an early concept. The dot-com bubble was only a handful of years before, and we saw a lot of data becoming much more relevant and much more available on the internet after the 2008 crash. Not only that, there's a lot more people out there looking at this data and talking about this data on the internet, keeping you much more informed along the way. When it comes to looking at data, we want to make sure we're looking at macro data, what's going on in the United States of America, and we also want to be looking at micro data, what's happening in your submarket, and is your submarket in trouble where the rest of the nation is not. Keeping in mind that pricing of a home is simply a function of supply of homes available and the demand to meet that supply. That's it. Two simple things. So where do we look? First, we want to look at vacancy rates. If you look at today in 2025, you can see that vacancy rates, the number of homes that are vacant at the moment, is near an all-time low. Going back over 50 years, we haven't seen vacancies this low. That means a lot of people are occupying the homes that are out there and available. You'll notice that back in 2005 and 2006, you saw a big uptick in vacancies leading to a 2008 and 2009 crash. Way ahead. The signs were coming, but yet people just didn't see it. Another really important piece of data to be looking at is delinquencies on mortgage. These are people basically, they haven't made mortgage payments, they're over 90 days late, and we see this rate increasing here as we approached 2007 and 2008. Indicating that trouble was in the water and it rose very, very quickly. As you can see right now, end of 2024 and 2025, delinquency rates are still near an all-time low. People are not defaulting on the debt, and that means that the lenders that are out there are not underwriting bad debt. That's what we want to make sure is that the rules for approving loans are good and we're not seeing big defaults in debts. When you see large bursts of defaults, it could put a lot of supply in the market all at once. The last bit of data that you need to be on the lookout for on a macro level is the supply of money. Why do we want to look at the supply of money? Keep in mind that your home value has a price, and that price is fixed to the value of something, the value of the US dollar in this case. If the federal government is inserting more money, or if banks are printing more money by means of lending more into the economy, then more money will be circulating in the economy, becoming available to purchase an asset. So even if vacancies are higher, but you see the M2 supply go up and up and up, it may counterbalance any effects that vacancies are happening in the economy. And as you can see, we saw spikes in the M2 supply post-COVID and during COVID, and that of course led to an inflationary environment in the real estate market. That it went down a little bit as they withdrew some, but it's gone back up since, putting upward pressure on price. All right, now we need to look at a micro level in your submarket. If you go to your local MLS, for example, I live in Houston, HAR often has a report on months of inventory available. This is basically the average number of buyers over the last year, and then the current number of months it would take the average number of buyers per month to consume the inventory that's available in your market. As you can see in Houston, we got down really, really low in 21, 22, and then as interest rates rose, we've seen a slow and steady uptick. We finally flattened out for our first month here in August of 2025 on months of inventory. So this means that houses are selling slower today because we're seeing a spike there. And if a seller does need to sell, they may start introducing discounts. So when you start seeing trend lines that go way, way, way above the running 5-year average, 10-year average in your submarket, that could be a sign that price weakening is on its way up. You'll want to talk with a real estate professional in your area to see if you're way overbuilt in your area or what's going on that may impact prices in your area. Keep in mind that if the macro and the micro are telling you different stories, the pain might be short-lived and it might not be very significant in terms of price correction. However, if both the macro and the micro are telling the same story, you might see some pretty significant corrections. So if you are in a market that has seen a few price corrections, how do you know when that market is beginning to turn? Well, you're really going to see that in the months of inventory being either flattened out or declining. And you'll also see it in the number of buyers year over year. We want to look at the year over year number because you don't want to compare, for example, July, a hot month, to February, a really slow month in real estate. You want to compare it on a year over year basis, July to July, to see if you're seeing an increase in buyers. Here in Houston, it's September of 2025, and in August, we saw a 12% increase in buyers from August of last year. And you're noticing a very clear trend line for almost a year now where the buyers are increasing on a year over year basis. That means that buyer confidence is returning and people are getting back into the market and buying. Now, listings, of course, will also play into that. So you need to watch both active listings and buyers and just see how your market is moving. But that's how you'll see the signs of early turn. Price is always a laggard, both to start dropping and then to start going back up when it comes to that. Look at the activity, which is number of transactions and buyer confidence to figure out when it is turning. All right, so now let's talk about the bad data. The data you do not want to look at when you're determining where the real estate market will go. Interest rates. I know interest rates can make people be happy or sad or joy or whatever, but interest rates and fixed prices are not linear. And you'll notice this because here we have a chart of interest rates from the 70s to the 90s, and you'll see these gray marks are showing where the recessions occurred. We had interest rates pretty much all above 7%, spiking way, way, way high into the teens, making houses very challenging to buy. But if you look at prices over the same time, you'll notice that they had a steady up and to the right motion as prices continued to increase. Yes, there were a few dips for 6-month or 1-year periods. However, prices held very stable with very little downward action during those times. We often tend to remember 2008 and think, hey, when interest rates go high, or you have a big real estate crash or a recession, that real estate's gonna tank. And that's not the case. That was not the case at all for the majority of recessions in the United States. And while we're looking at that chart for price, you'll notice that each of those recessions, of course, we had an increase in unemployment, which is what made it a recession. Yet at the same time, even though unemployment raised, people still bought houses and they were willing to pay more. And this is all in a high interest rate environment. The reason being is when people need homes and population is increasing, they're gonna find a way to buy that home. It might hurt them financially in other areas of their life, but they find a way to make it happen. So vacancy and the demand is much more important to look at than recessions, unemployment, or interest rates. I hope that helps you understand what to look at. If we can help you get more detailed on what's happening here in Houston, send you a more detailed report, reach out to us on our website or give us a call. We'll see you at the closing table.